Buying a company's stock is one of the oldest, simplest, and most common ways to invest your money. When you buy stock, you're not just clicking a button on your phone. You're actually purchasing a piece of a real business. And if that business grows, performs well, and becomes more valuable, the portion you own can grow in value too. In this video, we're going to take a deep, beginner-friendly look at what stocks are, how they work, and how people make money by investing in them. We'll break things down step by step so you can follow along easily, even if you've never bought a single share in your life. Let's start from the very beginning. What exactly is a stock? It's a term you hear all the time, but what does it actually mean to own one? Let's break down this fundamental concept of investing. In the simplest terms, a stock is a unit of ownership in a company. Think of a company like a giant pie. When a business wants to raise money to grow, it can decide to go public. This means it slices that pie into thousands, sometimes millions, of tiny pieces called shares. Each share represents a fractional piece of the company. If you own a share, you legally own a piece of that business. This gives you a claim on its assets and a share of its profits. It might be a very small piece, but it still counts. You're officially a part owner, also known as a shareholder. If an investor or institution owned 5 or 10% of all available shares, they would have serious voting power and influence over the company's direction. But most individual investors only own a handful of shares in any given company. In this case, your influence still exists, but it's so tiny that it doesn't really affect day-to-day decisions. Still, as a shareholder, many companies allow you to vote on certain important issues, like electing the board of directors or approving major company changes. So while ownership and voting rights are part of the package, they are not the main attraction for most people. The primary reason investors buy stocks is much simpler: to build wealth. Why companies sell stock in the first place? Before we dive into how you buy and sell stocks, it's worth understanding why companies offer them at all. It's a fundamental concept that underpins the entire stock market. Imagine you're starting a business. Maybe it's a tech company, a restaurant, or the next big social media platform. You have a brilliant idea and a solid plan, but you've hit a ceiling. To grow the business, you need money, often called capital. This capital is for more equipment, a larger team, or a bigger marketing budget. You could take out a loan, but loans have to be paid back with interest. This can be risky, especially for a young company where cash flow might be unpredictable. Another option is to sell shares of your business. This means you're selling small pieces of ownership in your company. When a company sells stock to the public for the first time, it's called an initial public offering, or IPO. In an IPO, the company sells these shares to the public in exchange for money. This money can then be used to expand, hire employees, develop new products, or pay for whatever the company needs to achieve its goals. After the IPO, the company usually doesn't get money when shares are traded. At that point, investors are buying from and selling to each other on the stock market. The company has already received its capital injection. The stock market is just a marketplace. When people hear stock market, it can sound intimidating. But the stock market is simply a marketplace where buyers and sellers exchange shares. Think of it like eBay, but for companies. You're not buying sneakers or collectibles. You're buying pieces of businesses. As long as there's someone willing to buy and someone willing to sell, a trade can happen. And once you place a trade through a broker or investing app, the stock becomes yours. How investors make money? 2 main ways. So you own a piece of a company. But how does that ownership translate into actual money in your pocket? Let's explore how people make money with stocks. There are 2 primary methods investors use to generate returns. 1. Price appreciation. This is the most common way investors profit, often referred to as capital gains. The core principle is simple: buy low, sell high. If you buy a stock and its demand increases, the price goes up. For example, if you buy a share at $20 and sell it later for $30, you've made a $10 profit per share. That's price appreciation. The key idea is that the market is driven by what investors a company will do in the future. A company might not be profitable today, but if investors believe it has a groundbreaking product or a strong growth plan, the stock price can still rise. You're investing in its future potential. 1. Dividends. The second way is by receiving dividends. This is when a company decides to share a portion of its profits directly with its shareholders. Think of it as a reward for your ownership. These payments usually happen on a regular schedule, often every quarter. Not every company pays them. Younger, high-growth companies typically reinvest profits back into the business, but many stable, long-established companies do. Dividends are popular with long-term investors because they provide a reliable stream of income, regardless of the stock's day-to-day price swings. It's like the company saying, "Thank you for your investment and confidence in us. Here's your share of the profit." Why do stock prices move? Stock prices constantly move, up, down, and sometimes sideways. But why? Let's go through a few of the biggest factors. Company performance. If a company reports strong earnings, launches successful products, or shows solid leadership, investors take notice. Investor expectations. Even rumors or predictions can move prices. Sometimes, stocks fall even after good news, simply because the news wasn't as good as people hoped. The overall economy. When the economy is strong, investors tend to buy more stocks. When the economy struggles, people often sell and look for safer investments. Supply and demand. Just like any marketplace, price is determined by how much people want to buy or sell at any given moment. Market sentiment. Sometimes investors simply feel optimistic or pessimistic. Emotions play a surprisingly big role in the stock market. These factors all blend together to create the price you see on your screen. How to buy stocks. To invest in the stock market, you need a brokerage account. This could be through an app like Webull, Robinhood, Fidelity, or any number of platforms. Once you create an account, you can buy and sell stocks anytime the market is open. Some platforms charge fees per trade, while others are completely free. And don't worry, modern brokerages make the process extremely simple. You don't need to be a financial expert. If you can shop online, you can buy a stock. Many platforms also offer paper trading, which lets you practice trading with fake money. It's a great way to learn without risking anything. Different types of stocks. Most people are familiar with common stock, which gives you ownership rights and sometimes dividends. But there's also preferred stock, which works differently. Preferred stock typically has more stable prices, pays higher dividends, but usually doesn't include voting rights. Most everyday investors stick with common stocks, but it's good to know that multiple types exist. There are also growth stocks, which focus on fast expansion, and value stocks, which are shares considered cheaper compared to their true worth. Each type comes with different risks and rewards. Long-term versus short-term investing. There are many strategies for investing in stocks. Short-term traders try to profit from quick price movements, sometimes buying and selling within days or even hours. This approach can be risky and requires constant attention. Long-term investors, on the other hand, buy stocks and hold them for years. This strategy relies on the idea that strong companies grow over time. And historically, the stock market has trended upward over long periods. One approach isn't better than the other, but long-term investing tends to be more beginner-friendly and less stressful. What are ETFs? Before we wrap up, it's important to talk about something extremely popular among investors: ETFs, or exchange-traded funds. An ETF is a collection of many different stocks combined into one investment. It's like buying a whole basket of companies instead of picking individual stocks. For example, a technology ETF holds many tech companies. A healthcare ETF holds medical and pharmaceutical companies. A total market ETF holds stocks from the entire market. ETFs are great for beginners because they lower risk, offer built-in diversification, and usually have steady long-term growth. They're also traded just like regular stocks, which makes them easy to buy and sell. Final thoughts. Owning stocks means owning a piece of a company. If the company grows, your investment grows with it. Whether through price increases, dividends, or long-term compounding, stocks have helped millions of people build wealth over time. You don't need to be a financial expert. You don't need to start with a lot of money. You just need patience, curiosity, and a willingness to learn. And now, you have a much clearer understanding of exactly what stocks are, how they work, and why they're such a powerful tool for building your financial future.